Okay, today we will study budgeting and budgetary control. First, before starting budget, I will ask you, do you ever prepare budget? Everybody, every day prepare budget, I will say. Because suppose all of you are, I think, students, and you are getting pocket money. Like suppose you came to your college and return back to home, and you every day you get like 100 rupees, 200 rupees, or maybe 500 rupees. And when you get pocket money, accordingly for today you plan how do I expend it. So suppose your mommy gave you 100 rupees, and you will plan, uh, first I'll have a breakfast and a lunch, and then return back to home. So fare is like 10 rupees, 20 rupees. That is must. I have to incur. So sharing auto fare is 10 rupees. Return is 10 rupees, 20 rupees. First, I will keep 20 rupees in my pocket. Then I'll expend breakfast like 30 rupees, and my lunch will be like 50 rupees. You plan like that. Everybody plans. And every housewife also plan their expenditure monthly, because their income, monthly income is certain. So they have to expend within that. They know their income is 10,000, 20,000, 50,000, 1 lakh, 2 lakh, whatever. But they have to plan accordingly so that they can meet all their necessary expenses, and they can save also. Accordingly, they will plan. So this plan is known as budget. Whatever planning they are doing, how much they will expend on fooding, how much they will pay rent, how much they will expend on their students, on their children's education, how much on traveling, how much on entertainment, how much rest will be saving. But some people are there who are more cunning at first, who are very much cunning. They at first save something, then they plan rest of things. Ultimately they adjust everything with their fooding. These are people, different type of people are there. Some people are don't think anything, they don't prepare budget, they don't envisage the expenditure, they only expend. Those people will be, they have to take loan, and their financial position will be worst, whatever income may be. So same thing also applicable to a country, and same thing applicable to a company, same thing applicable any business organization. If you are not planning your income, expenditure, or planning your income, what is receivable, what is payable, you are not planning, then you will be in soup. You will be the loser. So everything uh, should be planned before the action. So lot of things are there. Everybody, suppose a team is playing and they prepare strategy. That is different issue. Let it different. But things is same. We prepare budget. Then what is budget? Budget. Please write it down. Budget is the financial or quantitative statement. Budget is the financial or quantitative statement prepared prior to a defined period of time. Are you writing?
Yes, sir.
Okay. Budget is the financial and oblique or quantitative statement prepared prior to a defined period of time, prepared prior to a defined period of time of the policy to be pursued during that period. Okay, then to attain a given objective, one wrote it.
Yes, sir.
And then just take it out. Budget is the finance. Budget is the financial or quantitative statement prepared prior to a defined period of time of the policy to be pursued during that period to attain a given objective. Right? What do you mean by that? It is prepared prior to a defined period of time. I earlier told you that everybody prepare budget. That means you are preparing your pocket money for one day, and a housewife preparing budget for 1 month. Our country prepare budget for 1 year. Our company is preparing budget for 1 month or 1 year, whatever. Accordingly, it's a defined period of time for what you are preparing budget. The period is defined. First January 22 to 31st January 22. It is a defined period of time. For that, you are preparing budget. And again, budget is a financial and oblique or quantitative statement. Financial means everything should be in terms of rupees. All the incomes and expenditures should be in terms of rupees. And quantitative also. Suppose quantity, why quantity? How much sale will do, how, the quantity of sale, then quantity of purchase, then uh, quantity of transport, everything. It may be both or single. It may be only quantitative. So, prepared prior to a defined period of time of the policy to be pursued. I told you policy. What is your policy? I told you one policy that some people they are invest their plan to first out of their income keep something as their investment. This is their policy. The first investment, then expenditure. So this is the way the policy. Policy, there are different type of policy in companies also. Companies means that is uh, like flexible. They are preparing flexible budget, cash budget. Again, please write another. I'll tell you the policy. Mostly budget of the India is prepared. The policy is that they keep the interest of poor people. It is always like that. First, they will keep the interest of poor people, then defense, then other things are there, and like that, every organization, every budget should have a policy. Accordingly, there are different type of budget. One is cash budget. Please write down cash budget. Then production budget. Then purchase budget. Then sales budget. Then master budget. then flexible budget. These are the different type of budget. Then at first, let's study cash budget. What is cash budget? Cash means it does not mean that only cash. It is cash and bank both. Here it means cash and bank both. That means how much cash you are. Suppose you are preparing budget for next coming January. Then today is 31st December. You are preparing budget today for coming January. Then your cash budget means only how much cash or bank receipt. Here only mean you should mean the cash means cash and bank both. How much cash we will receive and how much cash we will expend. That is the cash budget. But before that, you have to take it has to be taken into consideration that today what is the closing balance we are having, that should be taken into consideration. Like, suppose today I am having opening balance, that is cash in hand or bank balance with me is 50,000 rupees, and coming year our sale will be like 5 lakh rupees. Then total receipt will be 5 lakh 50. Similarly, I will pay to my creditor 2 lakh rupees. I will purchase fixed asset 2 lakh rupees. I will pay salary 50,000 rupees. Then how much cash balance we will have? Closing balance at 31st uh, 31st January. Please tell me. Just add all the opening balance is your, it's like receipt opening balance plus your 5 lakhs is item. It may be cash sold or it may be receipt from debtor, that is 5 lakh. So total is 5 lakh 50. You are expending, you are paying your creditor 2 lakh. You are paying you are paying for fixed asset 2 lakh. You are paying for say fixed asset 2 lakh 10,000. The total expenditure would be like 4 lakh 60,000. Then closing balance at 31st March, 31st January 2022 would be 40,000 only. And in February, this closing balance will be opening balance of February. And again, all the inflows will be considered and outflows will be considered, and again closing balance will be come out. But here, discussing all the things, if it is not possible to show you depict it, it should be depict in the blackboard so that you can understand better what is the format of that. First, the first column will be the particulars. The second column will be first in particular receipt. It will be written receipt. Please do in that way. Please do that in that way. Write cash budget. Write cash budget at the top, and uh, put two columns. One is broader column, one is a little bit narrow column, and write opening balance first. First, write opening balance, that is 50,000. Add then receipt from debtor 5 lakh. Then total receipt is 5,50,000. Then then payments. These are all receipt and these are all payment. Payments means 2 lakh you will pay as 2 lakh will pay as to Sunday creditor, that will be in payment side, and 2 lakh 10,000 will be purchase fee furniture fixed asset, 2 lakh 10,000. Then and you are paying salary, that is 50,000. Then total is 4 lakh 60,000 is you are going to pay. So the total receipt is 5 lakh 50. Then you are paying 2 lakh 60. So closing balance will be 90,000. Sorry, earlier I told you 40,000. That is wrong. Your total receipt is 5 lakh 50. Total payment is 4 lakh 60. So closing balance will be 90,000. Do you understand, students? Yes or no?
Yes, sir.
Yes, that is the cash budget. In cash budget, another thing, some critical things are there. Suppose I will say you the receipt. Again we'll elaborate the receipt. Receipt. What are the source will receive? The receipt, under receipt, it will be, what are the receipt? Receipt will be like cash sale. Cash sale will be received. Then receipt from debtor, that will be received. And sale of fixed asset, that will be received. Sale of scrap, that will be received. And interest on bank deposit, that will be received. And your fixed deposit will be encashed. Suppose it will be encashed in January, and that will be received. All these things will be received. And in your payment side, all the payments like salary, wages, then purchases, payment to Sunday creditors, then cash purchase, then purchase of fixed asset, then payment of electricity, payment of power, payment of fuel, all this expenditure and miscellaneous expenditure, all this will be payment. And will all the receipt will added with the opening balance, and there will be total receipt, and all the payment will be added, that is will be total payment. When we will receive when we will deduct total receipt from total payment, our closing balance will come out. Suppose there will be total receipt is 1 lakh and total payment is 1,10,000. What you will say? What you will say this budget? Please tell me. Your total receipt will be 1 lakh and total payment will be 1 lakh. Sorry? Your total receipt in coming month will be 1 lakh and your total payment will be 1,10,000. How much closing balance will be there?
10,000.
Minus 10,000.
Good, good. Minus 10,000. What do you mean by that? That means your income is 1 lakh only, your expenditure is 1,10,000. This is a budget. What do you call it? What will you call? Have you heard anything about that? Please, anybody?
No, sir.
Everything knows it. Everything knows it. Please tell me. Smriti, please tell me. It is deficit budget, right? Hello.
Yes,
It
sir.
is
Sir.
it
Yes,
is
sir.
deficit budget. Have you heard about deficit budget?
No, sir.
No, sir.
You never read newspaper. Budget. India budget. Have not you studied? Suppose when total revenue is lesser than total expenditure, that is the consequence of deficit budget, because you don't have sufficient resources to pay out your expenditures. That is the deficit budget. In case of deficit, you have to increase your petrol price. Okay.
Okay, sir.
Please increase the petrol price and diesel price. You can meet your deficit. This is the strategy of our current Modi government. Okay, then this is all about the budget, cash budget. You can study it out of your book, and the number of sums are there. You have to solve it. Then you will get the. It is the simple, but one question will come out of that cash budget. Then we will study your production budget. Then we will study production budget. Production budget means that is purchase purchase of raw material, then factory expenses, then uh, then that will come uh, total factory cost. Then after getting factory cost, you will add the factory overhead. Then you will get factory cost. Then administrative expenses you will add. You will get the cost of production. Then we will add selling and distribution expenses. We will get cost of sale, and we will add profit. Then we will get the sales amount. In that way, we will prepare the production budget. Except that production budget, what happens? First, you have to analyze. Everything is prepared on the basis of sales. First, you have to prepare the sales budget. How much quantity you have to, what is, first you have to make the market survey in coming month, in January 2022. What will be your total sale? What is your market share? Suppose Tata is planning the total trucks will be sold in January all over India. It will be like 10 lakh 10 lakh trucks will be sold all over India in January. What is their market share? Say their share is 6,000. 10,000 out of 10,000, their share is 6,000. Then they will plan for 6,000 trucks, and again they will plan their production budget. So if there will be sale of 6,000, you can sell 6,000. What is their opening stock? Their opening stock is say 500. So they have to, at least they have to produce 5,500 unit to meet the uh, January month production, January month sales demand. So in that way, when you will prepare production budget, your all the to produce 5,500 trucks. What is the raw material will be required? That is steel, then plastic, then all the machineries, all the components, all the spare parts, everything will be how it will be collected. That will be calculated in quantitative quantity will be calculated. So accordingly they will produce it. So that is production budget. And again, this is again now it is sales budget, then production budget. Then after preparing sales budget and production budget, uh, you have to another budget is that is flexible budget. What is flexible budget? Flexible budget means suppose your 100% capacity of your factory is uh, uh, 1 lakh unit you can produce, and your total your at present level you are producing at 50% capacity. That means you are producing 50,000 unit, and when you will produce 60%, what will happen? When you will produce 70%, what will happen? When you will produce 80%, what will happen? When you will produce 90%, what will happen? When you will produce 100%, what will happen? So see, one thing we have already discussed in previous class, that your fixed cost will remain fixed up to 100% capacity level, but your variable cost will be changed. So that will be suppose you are operating at 50% capacity, your fixed cost will be remain same at all level. At 10% capacity, it will same. At 20% same, 50% same, 80% same, 100% also same. But your variable cost will keep on changing. So accordingly, we will prepare the budget. Right. So these are all about budgets. You can it is not possible on my part to make you understand verbally. It is you have to attend the classes, offline classes, so that you can understand it better. Okay, that is budgeting is over. Then we'll start another chapter, that is funds flow and cash flow. Are you ready for that? Hello?
Yes, sir.
Yes, sir. Okay. Then we'll start fund flow and cash flow. What is funds flow? What is cash flow? Funds, what do you mean by fund? Fund means the working capital. I have already taught you what is working capital. Please tell me what is working capital.
So the difference between current assets and current liabilities is called working capital.
Vikas, very nice. Difference between current asset and current liability. That is that is known as working capital. Working capital is also known as fund. It is also nomenclature as fund also. What do you mean by fund flow then? Fund flow means what are the inflow and what are the outflow of fund. Can you tell me an example of inflow of fund? Anyway, the inflow of fund is issue of share capital, issue of your debenture, sale of feed asset, and fund from operation. That means your inflow out of your operational business, what business you are running, out of that what fund you get, that is fund from operation. That is fund from. Then what are the outflows? Outflows is paying payment of redemption of debenture, purchase of fixed asset, purchase of investment. All these things are outflow of fund. Then one thing, at the time of preparation of fund flow statement, first you have to prepare change in working capital. That means change in working capital means that will be the fund flow means it is difference between two balance sheet. Suppose balance sheet of this is we have to compare two balance sheet, like balance sheet of 31st March 2020 and 31st March 2021. If there is no adjustment, and you will find out the difference between, suppose share capital here is 10 lakh rupees on 31st December 2020, and share capital in 31st March 2021, it is 20,000 20 lakhs rupees, then there is a inflow of 10 lakh rupees. So similarly, you have to prepare change in working capital. Change in working capital means when we are comparing two balance sheet, you will have two balance sheet. Balance sheet for first year, balance sheet for second year. Then there will be all the assets and liabilities, and current asset, current liability also. Change in working capital means you will compare, when you will compare 2 years balance sheet. First, write the first year current asset and first year current liability in a column, and write second year current asset and second year current liability, like in this way. Suppose that is a stock, then debtor, then bill receivable, then bills receivable, then bank, then cash, all these things. Then again current liabilities are sundry creditors and bills payable. Suppose first year the current stock was stock was 1 lakh rupees, and second year it came to 1,50,000. It is a increase in current asset. That will be an increase in funds. If the sundry debtor was 2 lakh and opening balance, first year it was 2 lakh and second year it was 1 lakh 50, then there is a decrease in current asset of 50,000. Then similarly, if there is bills receivable, first year it was 50,000 and second year it was 70,000, then what what will be increase in current asset, increase in fund or decrease in fund? Bills receivable was first year 50,000 and in second year it was 70,000. It is increase in current asset or decrease in current asset?
Sir, increase in current.
Increase.
Increase or decrease?
Increase.
Increase. So similarly, cash was 10,000. Now it is 15,000. Increase or decrease? Please. Hello.
Yes, sir. It is increase, sir.
Increase. Then syndicator was 75,000 first year and now it is 50,000. Increase or decrease? Increase or decrease? Syndicator was 75,000. Now it is 50,000. It is a increase in fund or decrease in fund?
Increase, sir.
Increase in funds, sir.
Increase in fund. It is decreasing, but fund is increasing, right?
Yes, sir.
Then your bills payable was 50,000 and opening balance was 50,000 and closing balance was 60,000. It is a increasing fund or decreasing fund?
Increasing.
No.
Decrease in fund.
Decreasing. When current assets are it's a decrease in fund. When current asset increase, that is a increase in fund. When current asset decrease, that decrease in fund. When current liability increase, that is a decrease in fund. When current liability decrease, that is increase in fund. Okay.
Okay, sir.
After preparing the change in working capital, you will find out when you will add it, you will know what is the net increase or decrease in correct working capital, you can find out. Then after that, you will prepare fund from operation. Fund from operation. What do you mean by fund from operation? Funds from operation. What do you mean by that? Funds from operation means what fund you received from your current business. That means suppose you are running a garment business and your net profit is say your net profit is say 50,000 rupees and your depreciation is 10,000 rupees, then your fund from operation would be 60,000 rupees. Correct? And other adjustments are there, but you understand in that way. Then fund from operation, you will calculate opening balance of uh, PL account and closing balance of PL account. Then 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 add depreciation, and you will get the fund from operation. After you first you calculate change in working capital. If it is a increase in working capital, that will be come under application of fund. Then we will prepare a statement, that is sources and application of fund. Sources, first sources. Sources means that is uh, that is issue of share capital, then issue of debenture, then uh, maturity of deposits, then uh, fund from operation, the total inflows. We'll calculate total inflows, and then we will calculate total outflows. Suppose your total outflows are redemption of debenture, purchase of fixed asset, then your purchase of investments, then your that is increase in working capital. That is total outflow of fund. Total inflow must equal to total outflow. It is not possible on my part to make you understand the things. If we will solve the problem from book, it will be better. Okay. Do you have any doubt? Any chapter, please revise all the things. Do you have any doubt? Yes, Smriti. Okay, you don't have any doubt. Okay, we close our class today. Thank you.
Sir,
Yes.
yeah, sir, can we discuss a little bit about variance analysis?
Sorry?
Variance analysis, sir.
Variance analysis. Yes. Why not? See, what is difference between budget and variance analysis? You are making budget for whole the year, but variance analysis is like it is for production only. Like that is variance analysis is done for material, labor, then overhead variances. Material means your material cost variance, material price variance, material usage variance. Then let's discuss material cost variance. Before that, you have to understand how to calculate the variances. So first you have to set standard. Standard means, suppose for a bricks, how much material is required? first you have to make, it is a engineering concept. First you have to make a like method study or process study or time study, whatever. Time process study means how to prepare, what is the material required for one brick. That is this much of clay and this much of you have this much. It may be two type of bricks are there. One is fly ash bricks. This is one is your how much fly ash is required and how much cement is required and how much sand is required. You can set the standard. For one bricks, we need this quantity of material. Suppose today you produce 100 bricks, then what is your standard? That should be multiplied by 100. If it is less than that, then its variance will be favorable. If it is more than that, your material used more than that, then the variance is adverse. Then what is material cost variance? The standard cost, please write down the formula. Material cost variance. Material cost variance is standard cost of material minus standard cost of material for actual production. Standard cost of material for actual production minus actual cost. Have you wrote it?
Yes, sir.
Please write it. Standard cost of production, standard cost for actual production minus actual cost. Standard cost of material for actual production minus actual cost. Okay. Suppose you are producing a brick. Suppose you are producing brick. The standard material per kg is, write it down. Standard material per kg is 10 rupees. Standard quantity, standard price per kg is 10 rupees. Standard quantity is 1 kg and your actual price per kg is 12 rupees and actual quantity is 1.1 kg. What is the cost variance? Suppose we are producing 10 units of material. What is the cost variance?
So 3.2.
Galat. See, it is 10. Have you multiplied? You are producing 10 units. Suppose standard cost will be 10 into 1 into 10. That is 100 rupees, right?
Yes,
Right
sir.
or wrong?
Yes, sir.
Okay. then actual cost is how much? It is per kg is 12 rupees. Per unit is 1.1 into 10. 1.1 into 10. How much? 12 into 1.1 into 10.
Sir, 132.
Right, 132. Then what is your variance? You are expending 132 rupees. Okay, but your standard was 100. Is it a favorable or adverse variance?
Adverse variance.
Adverse variance.
So this is material cost variance. Then material price variance. For this problem, find out the material price variance. Material price variance will be actual quantity, bracket start, standard price minus actual price. That will be material price variance. Okay.
Yes, sir.
Actual quantity into standard price minus actual price. Wrote it.
Yes, sir.
This is price variance. Find out the price variance. Price variance will be how much? 10 into 10 into
Sir, is it minus 352?
it will be minus 20 only.
Minus 350.
Oh, nice. See, the actual quantity is how much? 10. Isn't it?
Sir,
One
actual
for
quantity you said is 1.1 kg.
I told 1.1. Actual quantity I told you what? 1.1 kg. Na? Then
Yes,
it
sir,
is 11.
1.1
Sorry,
kg.
sorry. 11 kg, right? It is 11 kg, correct. 11 into
100 minus
10
100.
minus 12. Actual quantity will be 11 kg. Correct.
Sir, can we
11 kg.
rewrite the formula as actual quantity multiplied by variance?
No, just actual quantity into bracket start standard price minus actual price. Standard price is 10. Actual price is 12. Right?
Yes, sir.
Correct. Then how much? 22 rupees. Is that correct? Is that correct or no?
Yes, sir, 22.
22.
22. Favorable.
So minus 22.
Minus 22.
Minus means adverse. Right? Then what is usage variance? What is usage variance? Standard price into bracket start standard quantity minus actual quantity. Standard price into bracket start standard quantity minus actual quantity. Standard price is how much? 10 rupees. Standard quantity is how much? 10 kg. Actual quantity is how much? 11 kg. Right or wrong?
Right, sir.
Then what is the result?
So minus 10.
Minus 10, correct? Then tell me what is your cost variance? What is your uh, price variance? What is your usage variance?
So cost variance is minus 32. Price variance is minus 22. And usage variance is minus 10.
Good. Then remember another thing. Cost variance is equal to usage variance plus price variance. Is it tallied?
Yes, sir.
Yes, sir.
Then do the problem in that way. Any doubt? Please tell me. Then same way your material variance, then labor variance, then variable over variance, then fixed over variance, overhead variance. Lot of things are there. But you just remember this formula. You can solve other also. Right?
Yes, sir.
Any doubt, please? Because do you understand variance?
Yes, sir. Yes, sir.
Any doubt? Anybody?
No, sir. No.
Okay, thank you. See you. Thank you.
Thank you, sir.
Thank you,
Wish
sir.
you all the
Happy New
best.
Year, sir.
Same to you. Thank you.
Thank you, sir.
Thank you, sir.
Happy New Year.
Okay,
Happy
happy
New
New
Year.
Year.
Happy New Year, sir. Happy New Year, sir. Happy New Year to
Okay.
all of you.
Happy
Happy
New
New
Year,
Year
sir.
to all.
Happy New Year. Happy New Year.
Same to you. Happy New Year to all. Happy New Year to all of you.
सभी को नया साल मुबारक हो
Same to you, bhai. Same to you.
Happy New Year, all of you.